Good day, everyone. This is Joseph Trevisani from Worldwide Markets. I thank you all for attending this webinar, wherever you are in the world, our fascinating internet connection world. The title today is The American Economy, Federal Reserve Policy, and the Dollar in the New Year. Before we get started, I'd just like to give a couple of notes, as we always do. I prefer to run these as, even though I do most of the speaking and most of the typing, as a colloquium. So if you have any comments, jokes, criticisms, observations, anything you'd like to share with myself or the other people in attendance, please do. Just type them into chat. I'll be glad to stop and answer any questions, no matter how far afield they are. I think the more we can include in the view of the world in general in these webinars, the better they are. We have a, for the past, let's say 5 months, since May really, but you can look at this graph, this chart here of the currencies. We have kind of a new currency world that we've all been trading in. The dollar has been ascendant. The U.S. economy has been ascendant. The Japanese are desperately trying to reinflate their economy, despite 25 years of proof that reinflation of the economy doesn't do any good economically. The Europeans are trying to do the same thing. The view that changed in midsummer is the view that we're talking about. It's the idea that the U.S. economy is now going to roll right through, if not to the promised land, at least to a much better place than it's been in before. It would also be empirically, perhaps if not conclusively proved, justification for the Fed's QE policy for the past number of years. This, of course, leads to the conclusion, the scenario, the market scenario, if you will, even though I don't think it's priced into the currencies yet, that sooner or later, preferably sooner, preferably the middle of next year is kind of the market scenario right now, the Fed will start raising rates. I'm finishing my column for this week, and I'm calling it, well, the second part of it is called The Lure of the Normal. And that's really what we're going to be talking about here today. By the lure of the normal, I'm referring to the idea that the Fed must and will, over time, when it can, revert to a normal rate policy. Let's take a look at that for a second. What would we define as normal rate policy? Where are my CB rates? You have to excuse me, friend, I put a lot of graphs up, and then I have to go find them because they're not actually organized as slides. Where are my CB rates here? Here they are, CB rates. Okay. These are CB rates going back, as you can see, about 10 years, a little bit more, 20 years actually. How do we define normal? My idea is that the scenario that the Fed will, and remember we've been listening to this for a couple of years now, the Fed's going to start raising rates. Normally it keeps getting pushed off. U.S. GDP today was, I can't avoid it, excellent. But let's look at this, right? So what in this world, what would define normal? The assumption is something more along the lines of the historical rates. That's the assumption. The longest, the rates with the longest low here, the Fed going back to late 2008 under Bernanke, the Japanese, which is the purple at the same time, green, the UK base rate, yellow, the Euro EUR rate, the ECB rate, and red is the Australian rate, just as a industrial emerging market country. It's not really an emerging market country, but in a resource-based commodity, which resource-based economy, which has more in common with the emerging markets I'd use as an example of it. So in this kind of world, with rates at historical lows going back now 5 years, what is normal? The idea that we're operating under here, all commentators, you read it everywhere. I'm guilty of it myself. I write it sometimes myself. Fed's going to normalize rates. What is normalizing rates in this world? I'm not sure we know. And I'm also not sure, because I'm not sure we know, I'm not sure that the standard analysis is going to provide an answer. Put it another way. It's not enough, I think, for the Fed, and please, when I'm going to post this column later on today, I'm actually kind of interested in this topic and in this particular column, the idea for this column. I write a weekly column, although I have not been very reliable. We are returning to this as a weekly basis. It'll go up on Thursday every day. This week's going to be a little early, but generally it's going to go up on Thursday. Anyway, the idea that the Fed must return to a normal rate policy is something I think we need to examine. And we need to examine it in the context of the Fed's own criteria, economic criteria, what they say they're looking at, what they're going to do. And we're going to go through a brief run of a number of statistics in the U.S. economy to see whether these fit the criteria for the Fed. Now, remember what the Fed has been doing. Okay, so let's start from the beginning. The Fed's idea is normality. But we no longer really know what normality is. One of the great criticisms of the Fed, both low rate policy and QE, was that it was going to bring on inflation. That was sort of the standard analysis, historically based. We all know the answer to that one. It hasn't happened. Now, it may be happening. There are a few indicators that wages may be starting to move. And once wages started to move, that's when inflation enters, because then, and only at that point, can producers and retailers gain pricing power. If consumers have more money, then they're more likely to spend it. But if they don't, it doesn't matter what the Fed is doing, you're not going to get inflation. We haven't gotten that. So that normal assumption has proved untrue. Another normal assumption: the Fed will, as a cyclically based entity, meaning it's attempting to be counter-cyclical with its rate policy, when the economy starts to heat up, it raises rates so that it don't get inflation, it doesn't get overextended, and the reverse, of course. When the economy starts to falter, the Fed lowers rates to prop it up. That's the idea of the way the Fed works its policy historically. But right now, do we need a Fed that is countering a business cycle? Because we can easily ask, what business cycle? Put it another way. The Fed's historical role is the one I just outlined. But now, the Fed not only needs, in my view, a economy that requires its counter-cyclical approach. In other words, if the economy starts to get better, as it has been, I mean, we now, if you look at GDP for the last 2 quarters, the third quarter and the second quarter of this year, the average GDP, now remember, the federal government, in their sort of sneaky way, changed how they account for what they include in GDP, and they included some extra things. I forget exactly what, some services things, if I remember. I'm not 100% sure. Which had the effect, lo and behold, of raising GDP. It's just the way the Fed counts their inflation. They take out things that cause inflation, and they say, we have a lower inflation rate. It's not true. Nevertheless, those are the figures we're looking at. They become truer when you have a long history of the change statistic, because then you're comparing likes with likes, but right now you're not. But at any rate, the last 2 quarters, 2 and 3, GDP Average 4.25% annualized in the U.S. Except for China, it's probably about the best in the world. Certainly the best in the industrialized world. Those are the kind of statistics. You've got similar statistics. You're all familiar with them, so I'm not going to go through them. But I will give you some examples and then some things to question. The other thing that the Fed has been focusing on endlessly, relentlessly, ad nauseum, if you will, but that's what they're supposed to do. Bankers are not supposed to be interested. Employment, non-farm payrolls. Those have also been producing very steady gains, certainly this year and going back, 200,000 plus, which is well beyond the number of jobs needed to create, to satisfy population growth, although it's not been the kind of explosive growth we've seen after past recessions. This was not a business cycle recession. This was a balance sheet recession where everybody had to clean up and stop buying. So it's a different character. But anyway, so just taking those two and combine them with inflation, you have the basis for the Fed to say we need to start considering raising rates. The counter-cyclical idea of the Fed. Based on that type of historical analysis, that type of historical situation, even though we are largely in an ahistorical situation, people who write about economics, people who comment on economics, people who hold webinars, have a tendency to take the historical model and just extrapolate it. It's very difficult once you're in the middle of it, to find the historical exception and then realize how to deal with it. In fact, in most cases, you can't realize it. The Depression is an excellent example. It was dealt with by the Fed and others from historical examples, which proved to be woefully inadequate to what was going on. So if the Fed is simply going to look at this stuff, that's a technical term, I suppose, yeah, is going to view this and their role purely as the historical model, then, yes, I would say the speculation that the Fed will return to a more normal policy, assuming, of course, that we don't actually know, and I don't think the Fed knows either, what a normal policy is now, then we should start looking for a rate increase next year. But my idea is, in this situation, that the Fed not only needs to, the reason for the Fed, and put it this way, the historical paradigm is not enough in this current situation. The Fed also needs a positive reason for starting to raise rates. And I don't think the Fed has it. And it's my thought that the Fed is going to continually put off raising rates until something in the economy compels them. But let's take a step back, okay? This is the central bank rates. Nobody can tell me that looking at the past 5 years that anybody has a clue what the normal rate world is now and going forward. We know what it was in the past. If you have a 30-year chart, what you have is a slope from left to right on inflation, and this is worldwide. You can look at almost any nation you want, and a slope from left to right on central bank rates. That's the world. Now, you can make, well, I'm not going to make the population argument. It's my favorite. It's too early to do that in the show today. The show. Is this a show? I guess it is. Okay, let's look at some of the U.S. Let's take a step back and look at the economic statistics briefly. We'll go through them quickly because I don't want to spend too much time on them. Each one is just a snapshot of the U.S., okay? First, we're going to look at what the Fed is looking at as far as the overall economy goes, okay? So let's start with, where do we start? Let's start with GDP. Did I put GDP up here? Sorry, folks. I know it takes me a second to find these. That is sort of the way this is. Where's my GDP chart? All right, I don't see, here it is, GDP chart. Okay, this is U.S. GDP, annualized. Looks pretty reasonable. As I said, from the statistics, we've got 4.25% over the past 2 quarters. If you go back a year, the average is 3.6 annualized. There is nothing wrong with 3.6 GDP in a mature industrial economy. In fact, it's really good. It's really good. The Europeans can only dream of 3.6 GDP. The Japanese can only dream of 3.6 sustained GDP over a year. If you go back 6 quarters, or 7 quarters actually, the average is 2.7, not terribly shabby. The numbers are starting from the beginning of January of 2013, 2.7, 1.8, going forward, 4.5, 3.5, negative 2.1, 4.6, and 3.9. So excellent GDP numbers. They're not excellent, but very good. There's nothing to complain about for these GDP numbers from the Fed. So for whatever the reason, the Fed can say it's, their QE policy is working, low rates are working. I don't know that that's the case, but the numbers that are coming out are good. Okay, so let's look at some of the other numbers here. Here we have industrial production. My contention here is going to be that there are enough concerns so that we're not sure what the Fed's going to do, and I don't think the Fed's sure either. Anyway, so here's industrial production, a relatively volatile number, has fallen off recently. Nevertheless, again, not a concern of the Fed. Here we go. Durable goods. Since the summer, there's been a fall. Let's take a look at industrial production here. We'll have another one here. Again, September, a fall off, but these are volatile numbers. Same here, durable goods orders. These are durable goods ex-transport. That means ex-transport means you take off what basically Boeing sells, and that's your number. Okay. Durable goods. Here's capital goods. This is the equivalent of business spending. It's called capital goods, new orders, non-defense ex-transport. It's basically business capital spending. This is somewhat of a concern. Now, we don't have the new numbers out yet, okay? But this is somewhat of a concern. You can see it's down 1.6. But again, these are pretty volatile numbers. Factory orders. These are the two wackiest numbers in creation here. They have to do with Boeing. When Boeing had about a 300 plane month back here and then about down to 100. So the swing back and forth is not statistically important because it really relates to one company. And there again, moderately doing well. And the GDP you saw. Okay? So from an industrial point of view, the U.S. is doing reasonably well. And everyone agree with that. Okay. Now let's look at some of the sentiment numbers. Those are actual numbers. They're essentially retrograde. You look backwards, not forwards. Okay, let's look at the ISM numbers. This ISM, there's a little more concern here, but not a lot. This is ISM Manufacturing. Okay, this is from the Institute for Supply Management. They do a survey of purchasing managers. How do you feel? Oh, I feel great. I've gone back to the gym. No, that's not what they ask. How many new orders you're having, basically. What's your view of your business going forward, your business now, your business 6 months, how many people are going to hire, stuff like that. As you can see, for the ISM manufacturing, now manufacturing is usually used as a leading indicator for the economy, and the reason is, even though in the U.S., the manufacturing, the actual sector that makes things, is probably only about, 12 to 15% of the U.S. economy. Most of it is service. Nevertheless, because of lead times involved and the greater planning involved in manufacturing, it's taken as a leading indicator for the economy. So here, from December of last year to where we are now, almost finished with 2014, you've had a steady improvement in the manufacturing outlook. Very different from the period of 2011 to 2012 and into the middle of 2013. where, and this can be blamed, I suppose, on weather. Maybe we'll have another weather like that this year. I don't know. We're supposed to get snow here tomorrow. It's for Thanksgiving. That's pretty unusual around here, snow that early in the year. Anyway, so the ISM Manufacturing looks pretty good. Okay, now let's roll down to ISM Services. ISM Services doesn't look quite so healthy. Sorry, it looks like I cut this chart off a little bit. It's hard when you're doing 20 or 30 charts to get them all completely positioned. Anyway, so ISM Services, perhaps there's some concern there. Now, this is a little different. There's a private British company called Market Economics. They're based in London. They do the same type of survey, basically. And theirs looks very concerning. That there has been some sort of slip since the summer in manufacturing, a fairly serious one, I would say. Although it's still positive. Remember, anything above 50 in these types of indices means that everything's still the sector's still expanding. Okay, and let's look at their services. Ooh. Now, I can't talk about, because I don't really know, the difference in these two surveys, but you have two very different responses here. You have the ISM, which is the older one. It's been going on for like 50 years, I think. Institute for Supply Management shows ascending sentiment in the manufacturing and the service sector. You have Market, a relative newcomer, who shows declining sentiment, although both still positive in the manufacturing and the services sector. So you have a question. You don't have an answer. You have a question. Now, just interestingly, Market is one of the few private companies that I know of that's operating in China, and they produce a ISM, what they call Purchasing Managers Index for China, both services and manufacturing. And there is also a government-sponsored one. ISM, Institute for Supply Management, and Market Economics are both private companies. In China, you get the survey from the government, which is uniformly better than Market's survey. So, can we discuss Market's results? We cannot. I'm not really sure. We just have to look at them and see what they are. Okay, so let's look now at the consumer side. So from the industrial side, from even the industrial investment side, including capital goods investments, and sentiment, we can see that the U.S. economy looks pretty good. There are questions, but nevertheless, there are enough answers, if you will, even if we don't have them for Market. So let's look at the consumer side. Personal income. A year-on-year increase. Nothing to write home about, but nothing terrible either. Certainly there's been no dramatic fall. I mean, one of the things that has been spoken about in the commentariat and criticism and everything else over and over again is that even though jobs are being created, there hasn't been any growth in wages. And that's the biggest problem for the economy by many commentators' view right now. It's why there's no inflation. It's why you're not really seeing any kind of surge in retail purchases despite the jobs. Now, there's an answer to some of that, which I'll talk about in a second. But anyway, if we look at this, this is personal income, 4.1%, a nominal number, meaning not accounted for inflation. And this is 2%, 0.2 in the latest month, which I think was September. Okay. As you can see, not bad, not terribly good, but excuse me, when you have children, you have coughs. My kids have coughs and I have coughs. Sorry about that. Now let's look at average hourly earnings. Again, the same type of thing. For 4 years now, This is year on year. Basically no improvement. Remember, nominal numbers, not corrected for inflation. Inflation's 1.5, 1.4, whatever you want to say. So yearly income, this is 2, actually, sorry about that, is not growing. Okay, let's look at now. Retail sales. There are, I try to separate numbers. There are sentiment numbers, and then there are actual performance numbers. The various ISM and market numbers are sentiment numbers. The real ones are the ones that the people involved in giving you those sentiment numbers actually go out and do. So if you're looking at ISM Services or market manufacturing, PMI for manufacturing, the comparable performance statistic is capital goods. Meaning, yes, the ISM purchasing managers say things are looking good. Are they actually going out and ordering, spending money? Same with consumers. The performance, let's go the other way. Let's take a look at the statistic number, the sentiment numbers first. Okay. So this is the University of Michigan confidence number. Wow, looks good, right? Highest reading since the recession, since the financial crash. Now, we have a bit of a counter here. This is Conference Board. University of Michigan does it with Reuters and Thompson. Conference Board is a business group. Their numbers are historically lower than University of Michigan's numbers. Same type of survey. What's your view now? Jobs easy to find. Are you spending? Is it a good time to spend money on this and that? Stuff like that. So there's a difference here between the two surveys. Conference Board shows a recent decline. University of Michigan shows a continuing advance. I would not say that they counter each other. I would simply say we look for which ones are supported by actual numbers. Two other numbers I want to throw in here. This accounts for some of the consumer, if not joyousness, at least, it's a good word, a positive attitude, not a great word, the fall in oil prices. I mean, I drive to work every day. I see the oil prices. So you can see that this also is a support for for the consumer. And in a way, this is a real sentiment number because the amount of money per individual family, and certainly week to week, is not a great deal, but it gives people a sense of a positive attitude. I just want to throw this one in. This is the Dow with its various QE manifestations going back 2 years. Sorry, folks. I do apologize for this cold, but I guess it's part of the territory of being a parent with little kids, I guess. This also helps to contribute to positive attitude, and it also contributes in a statistical way because some of the confidence numbers have as a factor the leading indicator numbers. Sorry, let me correct that. The leading indicator numbers, which is why nobody watches that much anymore, but you'll hear about it, includes equity levels, which doesn't really prove very much, to tell you the truth. So we have an ascendant Dow, partially related to the Fed's policies, but also, and there's something I want to just mention briefly. No market. I mean, the equity market's a little bit more than others because they have relative, how shall I say it, standardized views of price earnings ratios and things like that, all of which right now are high. If not historical, very high. On the other hand, there is no relative economically sensible level for the Dow. So if part of this run-up that you're looking at here is because of central bank rate policy, and I don't think there's any doubt that that is, if for no other reason there's no place else to put your money to get return, that doesn't mean that when QE stops, as it has, the market then returns to a different level, from which point it would erase all of the gains from quantitative easing and start its new fundamentally based levels from where it was before. That's not what happens. The Dow will continue based on new information. It does not revert. It doesn't revert to the mean, which is sort of the standard mathematical concept behind most indicators, most not economic indicators, but analysis, technical indicators, reversion to the mean. The Dow doesn't do that. The Dow simply starts out from where it is. So if quantitative easing, just for example, pushed the Dow till 16,000, then quantitative easing stops. The Dow doesn't drop back to 12 or 13, where quantitative easing started, if you will, and then start calculating its levels and trading based on economics. It starts out from where it is now, which is why, even though quantitative easing has stopped, with being taken over, which was the Fed's purpose, by better economic news, the Dow continues to climb. Okay, just wanted to throw that in there. So sentiment numbers look relatively good. Okay, so we have ISM, we have the sentiment numbers for business looking moderately good. One better, one worse. We have most of the industrial numbers looking moderate. We have retail sales. So now we're going to go, we went from the sentiment numbers. Now let's go to the actual numbers from the retail side. Okay, so we looked at the industrial side, the business side. Let's look at the consumer side. Okay, so let's start with personal income. We can put this one up here, okay? 4.1 nominal number. Remember, inflation's running around 1.5%, shall we say, so it makes this a 2.6 number. Not a terrible number, not a great number. Historically, a bit low, but not terrible. Month to month, there has been a fall off since this year. If you look from, over here in March, there has been a decline. Is this meaningful? Very hard to say. Average hourly earnings. This is the one that you hear quoted all the time. Average hourly earnings is not going anywhere. It hasn't gone anywhere since the recession. It has. It's gone down, actually. This is the one that is concerning to economists, that you hear about from analysts, and that is taken as a drag on the U.S. economy. Now, if you take this chart back 25 years, you'll see the big discrepancy, the big change since the recession. Despite the 5 years since the recession, there has been really very little improvement in average hourly earnings. Okay, so that is so we have consumers saying they're feeling good, although we're not sure why. We have average hourly earnings, personal income essentially flat. So let's look like retail sales. Okay, this is monthly retail sales. Remember, retail sales are not corrected for price changes. Nothing spectacular here to write home about. So although the consumers say that they're feeling better, the performance does not seem to be up to the emotions. And if we're looking for a reason, the reason is personal income. So let's take a look at retail sales control group. This is the retail sales number that goes into GDP calculations. Similar type of number. Not terrible, not bad, volatile, but not showing any sustained trend. And if we're looking at a number and we're looking at some sort of prediction for the future, what the Fed is going to look at, the Fed's not going to be so concerned about monthly variation. The Fed's looking for a trend. And we're not seeing in these numbers the kind of trend that might give the Fed comfort. Remember, we're running 70%, 66%, I forget what it is. Consumption in the U.S. supports the economy. With these numbers, you're not going to see a booming economy. Okay, now, let's look here. Now, what might be some of the reasons? Remember, we're still on the retail side here. This is, I thank you all for being patient on that one. Wow. This is, so what I was saying was that payrolls, let's look at payrolls here. This is, payrolls, the famous non-farm payrolls. Every Friday we have a party, once a month. Pretty much, certainly for the past 2 years, a steady production of 200,000 jobs a month. Good, not spectacular, but certainly good. Manufacturing payrolls looks very similar. Steady production. This is labor force participation. This is one of the issues for the economy. Because remember, there are two types of numbers. Most of the numbers that we look at are percentage numbers. How much it improved each month. Year-on-year numbers. This numbers can be interpreted more on absolute terms. Meaning, for the economy, the labor force participation rate gives you a sense of how many people are actually working. And for the overall economy, the unemployment rate may have come down from 10% to 5.8%. But it is paralleled on this yellow line by the decline in the labor force participation rate. Remember, I'll repeat, I know everybody probably knows it, but I'll repeat it anyway. The way the U.S. government on this particular statistic calculates unemployment, you have to have looked for a job actively the prior month. The prior month. That's it. If you didn't, you get subtracted from unemployment. Yes, I do, and I'll talk to that in a second. So the reason that the largest part of the reason, probably 50% or more, I don't have the statistics, that the unemployment rate has come down in the United States is because people have simply stopped looking for work. If you look at this rate up here, which is the U6 rate, it's people who have looked for work in the prior year or working part-time, prefer full-time. This is a much more accurate representation of the economic effect for the economy. Because what happens if somebody drops out of the workforce? Okay, they're no longer counted in the unemployment rate. Great. The government gets a better unemployment rate to talk about. But the economic effect is that that person is now removed from the economy. Not completely. They have to eat and get food and clothing and everything else. But from a full participation, meaning that they are both not working and they are also not spending. So the absolute dollars being spent is much lower because of the lower participation rate, even if the unemployment rate looks better. To that question, do any sub-bubbles in the market that are created by the low rate? Yes. In my mind, the equities are if not a raging bubble, certainly a simmering bubble. What has happened is that the low rates, and now I'm going to move to the Fed's actual policy and why I think it's far less likely that they're going to raise rates next year than everyone seems to think. The biggest item driving equities, not the only item, is lack of alternative. When the Fed, remember this back here? Let's see if I don't know if I brought a U.S. 10-year rate today. No, I didn't. Okay, let's. I think I have one with QE here to give you an idea of what's going on. Where's that GDP? Let's see what we got here. Okay, this is the U.S. 10-year rate. The reason I say that there's a bubble is the biggest problem with the equities, and remember, this is a purpose. This is what the Fed designed to do. They don't talk about much how they're targeting the wealth effect, at least not much under Yellen, but they certainly talked about it in the early days under Bernanke. A higher stock market is going to make everybody feel better because they have more money, and therefore they're going to spend more money. It certainly has not turned out to be the case. But this is the alternative to equities. And that's why you have so much pressure on equities. There's no place else to put your money. If you'd prefer to keep your money in bonds or something a little more secure and you get your principal back, what you're going to do in this kind of rate environment is you're going to allocate more money to stocks simply so you can bump up your return. Chasing yield is always a bad idea, but for the past 5 years, it seems like a good idea because the Fed's not raising rates, marginal businesses are not getting crowded out of the borrowing market, and the stock market keeps going up. So yes, in that sense, there is a bubble. One of the puzzles about this rate policy is that even though everyone is anticipating an increase in rates, rates aren't increasing. Standard procedure for the bond market is to front run everything. Everybody thinks there's about to be a rate increase. They pile in. But that's not what's happened. And the interesting reason is this. Take a look at this. German 10-year rate. 10-year. 10-year bond. And compare it to the U.S. Where's my U.S. rate? The U.S. is paying 2.3% for a 10-year. Germany's paying 0.76. Where would you put your money? Take a look at the French 10-year rate. France. I didn't put the Italian up. I should have. 1.1. 10 years. 10 years. This is the pressure on the bond market. This is the reason bonds haven't gone down, despite, remember what happened here, right? But this is the German. Let's put up U.S. Where's my U.S. 10-year? U.S. 10-year, right here, right? That's back in 2013, this late summer, May, I think May 22nd, when Mr. Bernanke first started talking about ending QE. The bond market had a normal reaction. We're entering a rate cycle. QE is a rate policy. Everybody starts buying, selling their bonds, raising their rates. They didn't keep going. First of all, the Fed blindsided everybody back in October of 2013 by not ending QE when everyone expected them to. And they blindsided them, everybody, again in December of that year, last year. By then raising rates. Sorry, folks, I don't want to cough into the microphone. So this is the issue for the bond markets. We're expecting a rate cycle, but nobody is acting like it. Nobody in the bond market is acting like it. If you were a French investor and you want to put your stuff in some sort of sovereigns, why would you buy? Now, of course, you have currency translation problems, and the euro has gotten considerably weaker. But why would you buy German debt? You go out and buy U.S. Treasuries. The latest Treasury auction I remember seeing was like 4 times oversubscribed. Why? That's the reason. So you now have an abnormal U.S., favorable U.S. bond market, Treasuries. Okay, so let's try and put all these things together because we have to end here shortly, I know. For the Fed policy. Let's take a look. Which chart I didn't put up the housing charts. They're not particularly useful as far as this goes. No, I think the dollar's actually going to head higher after this. But let me do a little more here, and then we'll talk some more about that. Okay. These are 30-year CB rates. Okay. The Fed's two basic concerns. They have 3 if you want. The overall economy. They have their 2 mandated concerns, inflation and unemployment, and they have their traditional role as the lender of last resort, the guarantor of the financial system. The last one we can just count up for the moment. The Fed is not terribly concerned that we're going to have a collapse in the financial system right now. The overall economy is getting better and so far better. That's a good qualification. Better and then so far better. Okay, sorry about that. And inflation is quiescent. And the unemployment has been improving. So all of these, by the Fed's standards, are moving in the right direction. With a lot of patience on the Fed's part, they're performing. This would seem to indicate, as I said earlier, that it's time for the Fed to seriously consider raising their rates to a more normal level. Granted that considering what's gone on, both in the evolution of inflation, central bank rates, and the world economy, and the 5-year evolution of the residue of the financial crash, nobody has a clue, and I'm sorry, nobody has a clue as to what normal rate policy is. Now, the Fed can't come out and say that. They can't come out and say the world has changed. I feel it in the water. It's a quote from the Lord of the Rings, actually. They can't say that. If you want to get the markets in a tizzy, just tell them we don't really know what's going on. They're not going to say that. They're going to use historically consonant rhetoric. They're not out to scare anybody. They're not out to make rhetorical flourishes. They're not out there to make theoretical inquiries into what is happening now and how the world financial system is changing. And I think it's changing tremendously. So they're not going to do any of that. They're going to go by their standard historical analysis. But what other items are involved in the Fed analysis, which could sway this? In my mind, delay raising rates. Okay. The world economy, Japan, China, Europe. The 4 biggest economic blocks in order of, I'll try and get to that. The world is changing because we're all getting older. And I mean that not facetiously, although it sounds facetiously. It seems to me that as the population on the world ages, at least in the developing world, which is what we're talking about, the economic activity starts to slow. The analogy, I guess, to a human being, as a human being ages, is probably pretty accurate. But that's the case, in my mind. Okay, so we have, of the 4 biggest economic blocks, which in order of size, GDP size, the EMU, the 18 nations, the United States, China, and Japan. Of the 4, the EMU is moribund. They're not doing anything. The United States is doing pretty well. China's growth is slowly ebbing, and no one should be confused by the fact that they're still growing 7.7% or 7.2%. One, that's a lot less than they were before, and two, that's probably overstated anyway. Chinese statistics not being terribly reliable. And then there's Japan. At the turn of the last century, they called the Ottoman Empire the sick man of Europe. Well, it seems to me that the Japanese economy is the sick man of the world economy. And there it probably relates directly to population changes. And structural changes need to take place in the Japanese economy or not. Okay. So the U.S. and the Fed can be looking at the world economy and say, oh, yes, the U.S. is autarkic. That means an economy relates only to itself. It's a great word. It's not the case, though. So the Fed and other planners have to look at the world economy and say, what kind of effect is this going to have on the United States? Two, inflation, deflation. What is Japan and Europe, and if you will, Russia, currently doing? They are exporting, hold on. Sorry. Sorry, that was a sneeze. What are they doing? I hate to get you involved in my health, but I have to shut the mic off so I don't. I'm going to have to tell my kids they can't schedule their illnesses when I have webinars. Sorry. I really do apologize for that. What are they doing? They're exporting deflation. What happened to Japan with their, do I have the yen up there? Let's see if I have, where's my currency chart? Yeah, I put the yen in here. Okay, let's see if I have the right time frame on this. No, it doesn't go back far enough. Well, actually, look at the dollar. Look at yen. It does. We have the DXY. The purple DXY is the dollar index. The purple is the yen. So with the yen worth 80 to the dollar, very high. What did that mean for Japan's prices? A strong yen. What does that mean? It imports deflation. Because prices in yen are low and went down. Because the yen is worth so much. That's exactly what is going to happen if the currency disposition now continues. A strong dollar imports deflation to the United States. What's happened with the price of oil? It's come down 25%. Even if you take, use the PCE, the core PCE that takes oil price, energy prices out, people don't pay the core price. They pay the overall price. Oil is lower. Oil is the basic industrial commodity. The price is things made with oil, energy. A strong dollar imports deflation. So the Fed's other great concern, deflation and lack of inflation, for the next year is likely to be pressured down. Let's take a look at the U.S. inflation rate here. I'm going to do CPI year over year. I know that's not what the Fed watches, but I don't really care. We could take a look at it. This is what the Fed watches. PCE, 1.4%. And it's come off. Okay, that's core PCE. Okay, and here is inflation. So the Fed going forward has to look at the likely pressures on inflation down. No, I don't think they would intervene. From the currency changes that we're seeing, from what Japan is doing and from what the Europeans are doing. So even though the Fed's pulled back on QE, money's fungible. Money runs around the world. There's plenty of QE still happening. And if the Fed gives an indication, which it has not, I read through the minutes of the last meeting, there's no real indication about when they're going to start raising rates. If Ms. Yellen came out tomorrow and said, well, second quarter looks pretty good, what would happen to the dollar? The dollar would soar. And what would that do? Import more deflation in the United States. Another factor, which the Fed is not going to talk about, it's very real. I don't know how this enters into their considerations. You never hear it in the minutes. You never hear it in Fed discussion, but it has to be. These are smart people. The U.S. debt. U.S. debt is largely, I don't know what the percentage is, short term. Year, 2 years, 6 months, whatever it is. That means the government has to keep rolling over the national debt at a relatively high frequency. If rates start to rise to the lower than normal, some normal, historically based level, the bill for the U.S. government for its debt starts to skyrocket. The Fed may not talk about this or put it in the meetings, but it has to be a consideration. I think the commodity currencies have reached, I think right now, the adjustment that you saw from the middle of the summer until maybe about a month ago has taken place. That was the factoring in of the change in the world economic outlook. With Europe slowing, China slowing, Japan in trouble, and the U.S. growing, but questions about how strong that can be with the rest of the world. So I think you've seen the adjustment on the commodity currencies up until now, based on that change in scenario. We're now, and that's why you haven't had a lot of movement recently. It's where the euro's been, running around between 24 and 26, whatever it is. Hasn't really done very much the past couple of weeks. That's the reason. We are now waiting to see where this is going to go. How much effect is the slowing world economy going to have on the U.S.? Will the U.S. continue to perform at 3.5% and 4% for the next 4 quarters? And I think there's pretty serious questions about whether that will be. So let's sum up here and take a look at what we're talking about with the Fed. The U.S. economy, it's performing well. The rates have not started to rise. The pressure on the stock markets, you can say, is from overseas as much as from anywhere else, at least the perception. All of that could change if the U.S. starts raising rates. I don't think, in my personal opinion, and I think for the Fed too, this is not seen as a very robust economy. Even though there are statistics which will give you the idea that it is growing and things like that, I don't think there's a sense that this is a very strong, well-founded, well-grounded growth. Okay. How would that be affected by an increase in rates? Because the Fed starts actually raising rates, not just ending QE. Will long-term rates follow? And there are questions about that because of the pressure from overseas people getting the return from U.S. Treasuries. So is the Fed going to want to take a chance that they raise rates, but the market rates don't follow, leading to an inverted rate curve? And inverted rate curves normally predict recessions. But do they create recessions? I don't think so. So the Fed is going to be, I think, have questions on that side. Then we have, of course, inflation and the currency conundrum. Japan and Europe, among other things, are looking for economic benefits from a weaker currency. Weaker currencies bring deflation into the stronger currency, which is the United States. Does the Fed want to risk that? Third, what are the necessary positive reasons for raising rates? The traditional historical reason is to prevent an overheating economy, because that leads to misapplication of resources, because it eventually creates a bubble which then blows up and creates a, not collapse, but at least a fall. It also usually leads to inflation. But none of those things are happening. And if the Fed is worried about an overheating U.S. economy, it doesn't have to do anything. It doesn't have to raise rates. What can it do? Close its eyes and point to the rest of the world. The idea that the rest of the world is not going to affect the U.S. and retard growth, I think, is foolish, and I don't think the Fed believes it. It's like Jean-Claude Trichet in the summer of 2008 raising rates. We got no problems here. Well, it didn't turn out to be the case. They did. So if the Fed is needing something to restrain the U.S. economy because it's getting overheated, which it's not, but just say it did, it doesn't have to use its rate tool. You just wait. Correct. So that is what I see. I don't think she can see that. Oh, we have to wrap up here. I'm heating from, but I've reached the conclusion here. So for the Fed policy, it seems to me that not only is it enough to posit the normal, that the Fed is going to start raising rates because that's what the Fed does in a situation like this. The Fed needs a positive reason. It needs to do this for a reason. Inflation, perhaps, overheating economy, and it doesn't have those. So I think that we're going to see, and again, I'm going to put these in a very succinct form in my column today, that what we're going to see is a very circumspect Fed, but one which continually pushes off the horizon for a rate increase because there is no reason to do so. Okay. What's the best currency to trade against USD? Whatever one is moving at the moment. Right now, I think that the euro is going to do another leg down because I would say the euro and the yen, because I think both of them, based on prospective government policies, are going to head down. The ECB is going to do its best to come up with some way to buy sovereign debt, and sooner or later they're going to. And Japan is going to do whatever it can to get its yen lower. So that's what I would do now. Okay, folks, I thank you very much for attending. I hope this was useful. I will, as I said, this column will be up at the latest tomorrow morning on our website. Please take a look at it. It's worldwidemarkets.com, all spelled out. And I will see you in about 2 weeks. Everyone have a very good day. And again, thank you for attending. I appreciate it. Take care.